Money at Work Continuing Education Series. Today's episode centers around why market timing is a really terrible idea. First of all, retail investors, they don't really have an understanding about the functionality of the stock markets or other asset markets, whichever one that we're looking at. In theory, the markets are going to be made up of people who actually understand the consequences of their decisions. However, in reality, that's just not the case at all. So these are the reasons that market timing is usually a losing outcome and a really bad idea. Number one is the probability of failure. Remember, market timing is going to be a flawed strategy because of the amount of decisions that are constantly having to be made. Two of the most important decisions is one, regarding when to get in the market, whereas the other side, the other decision is when to actually exit the market, get out of the market. If you understand that what we're looking at is a series of decisions, if we were to ignore some of the important details and just simply look at calculating probability, there's a 50% chance of getting one decision right. There's a 25% chance of getting both decisions right. Therefore, the likelihood that 1 in 4 bets will make money, whereas 1 in 3 will actually lose money. And over time, that starts to add up to a lot. People who believe in market timing, they really just don't have a clue that the odds are heavily stacked against them. In reality, there's probably less than a 10% chance they'll make a profit. Also, if they actually do make a profit, it ends up being lost in a future bet or wager, however you want to look at it. Studies have repeatedly shown that retail investors who believe in market timing, they tend to lose money almost with certainty. So let's talk about something else, the lack of consistency. Remember, the myth of market timing comes into more visibility when some retail investors make some money in a bull market. Remember, it's not hard to make money in a bull market, right? They do not realize that the rising tide lifts all boats scenario is taking effect, and their bets are going to be right because of the macro market bullishness. Timing the market with any sort of consistency is almost impossible. Even the best investors in the world, like Warren Buffett, they have a return percentage in the range of, 25 to 35% annually. It's weird to see that the average person can believe that profits of 5, 6, 7+% per day are even a possibility. And then next up is the constant cost of transactions. Remember, investors who believe in timing the market, those people are very, very profitable for the brokerage firms. The more stocks or cryptos or commodities, whatever it is that you're trading, are bought and sold, the more commission is paid to these firms. However, the commission is paid from the investor's pocket regardless of the outcome, whether it's a profit or a loss. Also, the government takes a higher rate of capital gains tax on proceeds earned by trying to time the market. Long-term investors do not have to face nearly as many costs as these short-term market timers. These costs constantly eat into whatever little profit they make, and that starts to diminish the returns that are being generated, if they're being generated at all. And then the next one is getting emotional. And this is an important one because the strategy of market timing becomes even worse when emotional factors and reactions get mixed in with it. Remember, retail investors are highly reactive to both those emotional fear and greed and panic and all of those typical factors. Also, they're very sensitive to both profit and loss. So their behavior is what creates short-term bubbles in the market. Retail investors are the ones that react the fastest to both greed as well as fear. And as a result, they buy when prices start rising and they sell when prices start falling, which is the exact opposite of what should be done in the market. And then finally, just history. In times of volatility, timing the market may seem tempting, but doing it is so impossible and it's such a costly mistake. Market timing is not easily achievable. So over a sustained period of time, almost all investors profit more by simply making an investment and holding on to that investment as long as the core asset of the company is still in a place that made you invest in the first place. It's a lot easier to look down the long term and make long-term predictions rather than constantly making the short-term ones, because large and long-term cycles like presidential elections and interest rate adjustments are a lot easier to forecast than the day-to-day, month-to-month knee-jerk reactions of any given market. Millionaire Mindset.life, stretch your thinking, create your vision, and achieve.